Welcome, everyone, to another edition of the Financial 15, a show where Kevin and I try to provide some value, something that can improve your financial life, and we try to wrap all of it up in 15 minutes or less. And today we're talking about the RRIF, the Registered Retirement Income Fund. Often we have a question of what happens to the RRSP when you retire? Well, the solution is the RRIF, and we're going to get into that today.
Yeah, basically what we'd like you to do is if you get a chance, subscribe to our Facebook page or our YouTube channel where you can find a whole bunch more videos that we're doing along these lines to make sure you get the information that you need.
You don't want to miss anything, but we're going to start off with that RSP to RRIF conversion. What happens to the RSP when I retire? So Kevin, someone comes to you and says, hey, I'm thinking of retirement. I've been saving for many years, putting money into the RSP. What happens next?
Well, yeah, basically there's three things that you have as an option. We're going to talk about the main one, but what you can really do is, A, if you want, you could cash out the entire RSP at once. Not recommended because you pay a huge amount of tax. Two, you could convert it to an annuity, at which point you're going to get a set amount just like a pension for the rest of the time. But the majority of people are going to do this one. What they do is they convert their RSP over to a RRIF. And basically what you get when you convert over to the RRIF is you're basically moving it from an RSP into what's known as RRIF format, or Registered Retirement Income Fund. The only real difference between the two is that in the RSP, you do not have to draw any money out. In the RRIF, you have to draw at least a minimum amount out. You can still keep all the same securities that you have, and you're just basically moving them from one side to the other. That's the biggest concern.
And that's a big one, the same securities. That is certainly a big one, because often you think there's a change, something's going to happen. It's really just paperwork. You're moving from one account to the other. All the investments can stay the same. And once you're in that RRIF, you hit on it, Kevin, you have that mandatory minimum withdrawal. Money has to start coming out of the account. And I pulled up the table here. Why don't you walk us through some of the details here, Kevin?
Yeah, basically what will happen is if you convert before the age of 71, as it says on the chart right there, 71 is the mandatory age where you have to do it. But there is no hard and fast rule. If you decide to retire at the age of 55, you can convert your RSP to a RRIF then, and you'll have a smaller percentage that must come out. So the percentages basically are a set amount from 71 on, and then before 71, it's usually 90 minus your age, and it uses a formula along those lines to figure out what exactly your percentage is. And that's where you're going to find out how much you have to draw out each and every year.
Yeah, you're correct. So there is a different formula from before 71 versus after 71, and they've tweaked these numbers a couple of times. They being the federal government, they set the tone here when it comes to these withdrawals. And the most recent update was done in 2015. That's the data we're looking at here, is the most recent table. How it works, by the end of the calendar year in which you turn 71, you have to do the paperwork. You can no longer have an RSP. It has to go into a RRIF. You don't have to take any money out, though. You simply have to do the paperwork. The following year, the year in which you turn 72, that's when the minimums kick in. However, how this table works is it's not based on your birth date. It's based on your age at the beginning of the year. So if you turn 72 in April, but at the beginning of the year, you're still 71, well, you use the formula at age 71, or in this case, 5.28%. That's how they use the formula based on age, and they apply it to the value of your portfolio at the beginning of the year. So at the very start of the year, if you had $100,000 and the 5.28% applies, that means $5,280 has to come out of the account at some time during the calendar year. And unfortunately, it's all tax. That's the catch here. The government's trying to get you to take some of that money out and pay a bit of the tax. Who determines the frequency here, Kevin? Is it monthly? Is it quarterly? How does the money have to come out?
Well, yeah, basically that is set up by the individual themselves. I mean, a lot of people will use this specifically like a pension. So a lot of people will do it on a monthly basis. And remember, that percentage is based on the entire year, not based on when you draw it out. So it's not 5.28% at 71 each and every month. It's 5.28% over the course of the year divided by 12 if you're doing it monthly. You can also do it quarterly. You could do it semi-annually. You could do it annually. It's whatever's going to work best for your retirement situation. Some people like to take it all out at the beginning of the year and decide how they want to spend it. Others, if they don't need the cash, they take it out at the end of the year. Maybe they use some of that to contribute to a TFSA or something along those lines. But the minimums have to be done over the course of the year, but you decide what's best for you, just like you would in the pension scenario going forward.
Yeah, and a couple quick points here. One is on the tax side of things. We mentioned the money comes out. You don't actually have to pay the tax on the minimum up front. We encourage that. It just makes life a little easier, but it's not mandatory. If you want, you can get the full amount in your bank account, and then at the end of the year when you file your tax return, you can square up with the government at that point if you choose, or you can have a little bit of tax taken every single withdrawal. It's up to you, but for that minimum amount, the tax does not have to come off the top. You do have options there. And then another point quickly here, Kevin, if someone has a RRIF, let's say at the credit union, they have one at the investment firm, they have a third one at the bank, how does that work? How does that work for the withdrawals?
Well, basically, it's the same percentage for each one over the entire amount. So if you have 100,000 at the credit union, you have 100,000 with an investment firm such as we are, you must take the 5.28% out of each RRIF. It is not based on, oh, I can take it out of one, I don't have to touch the others. It's the entire thing incorporated together. And as you were talking about in regard to taxes, you're right. There's no tax that has to be taken off on the minimum. If you take more than the minimum out, which is one thing that people may not know about, is that you can take out more than the minimum. So if you wanted to take out 10% or 15%, you could. But the rules start to apply the same way as they would with a RSP withdrawal. If you're taking 5,000 more, then there's a 10% tax, 5 to 15, 20, over 15, they're going to take 30 off the top. So again, one thing to emphasize, the minimum must come out, but you are not restricted to just the minimum. You can take out more if it's required.
That's right. Yeah, just to clarify there, the minimum, you have your options with tax. After that, you get into what's called withholding tax that Kevin just talked about. And then it depends on the amount you take out. If you take out 5,000, they have a flat 10%, between 5 and 15, a flat 20%, over 15, 30%. But that's not the final tax rate. Just to be clear, that's simply the government taking some money up front. And then when you file your tax return, they'll determine your total income and what you owe. And it might be more, it might be less, but the government is simply given a flat rate up front to make sure they get a little bit in their pocket before they send out too much money from that account. Anything else you want to add to that?
No, I think that covers the majority of what's gone on for how to convert your RSP over to RRIF. And as we mentioned, that's the most popular scenario to deal with and probably the most tax efficient for you going forward. But there are tips that we do need to know about that can help you in regard to converting your tips. What are some of those tips, Clint?
There are a couple of them for sure. One of them is that you can use the age of your spouse. So for example, if I'm 71 and my spouse is 67, we noticed on the chart before, the younger you are, the smaller the mandatory minimum. So I can use the age of my spouse. That'll reduce the minimum withdrawal. It'll give me a little more flexibility, make it a little easier in terms of taxes. So that is one thing you can do if you're setting up the RRIF. If your spouse is younger than you can use their age, and that will reduce your minimum withdrawal. A second tip here, Kevin, and this is a big one, it has to do with income splitting.
Yeah, basically income splitting can be done. One of the things that has been done with pensions, well, no matter when you convert it, is you can take your pension and income split it with your spouse so that you can be in a lower tax bracket, not pay as much going forward. Same can be done with the RRIF, but it has to be done after the age of 65. So if you're drawing out of your RRIF beforehand, you have to claim everything that goes on that for income. If you're 65 or over, you then have the option to income split it with your spouse so that you can get a lower tax bracket going forward. And that usually leads us to a third option, which is pension tax credit after 65, if you want to take that.
Absolutely. Yeah, and then the key item here, you've hit it a couple times, age 65. You take money out of the account before 65, you got to pay the full tax hit. After 65, you have the option, you can split it with your spouse. Same thing here for the pension income tax credit. Anything that qualifies as pension income, you can claim a $2,000 non-refundable federal tax credit. So that RRIF money after the age of 65 qualifies as pension income and allows you to claim that tax credit. Now, quick scenario here, Kevin. Imagine all the money is in your name. It's in a RRIF. You can take out after 65 $4,000, split it with your spouse. That way you each have $2,000. You both would then qualify for the credit, assuming you're over the age of 65.
Yes.
There
I know
you
that
go.
you want to go there pretty quick, but I'm getting close, but I'm still a fair number of years away before I'm hitting that 65 age frame. But I do like that scenario, and I think that's something important that everybody should know going forward.
Absolutely. Well, any last comments here before we go?
No, I think basically we've covered a lot of that. The big thing that you should do is that once you're getting ready to convert to the RRIF, find out from your financial professional the best way to make that happen, whether it's, converting to the RRIF, doing more money out, looking at an annuity or whatever else. We're going to recommend the RRIF 9 times out of 10 and tell you all the options that are there. Other than that, I think we've covered most points. Clint?
Absolutely. And that's the key. If you're taking anything away, that there's options. There's lots of options. You got to find the right fit. We talked about the RRIF, but you're right. There are other options. And a reminder to everyone, we like doing videos like this, like creating that free content. You can find it on the YouTube page, the Facebook page, or as always, you can contact us on the website. You can see the link there at the bottom, chat with Clinton and Kevin. RRIF.com. So we'll end it there. We'll be back again next week with another video. Until then, everyone, take care and stay safe.